Samvad Monthly Newsletter, August 2023. We present a matrix detailing some movement in some key market rates, domestic and global, and key events. Howard Marks always brings in a profound thought process. Penning his thoughts in the book, The Most Important Thing, he writes in, Rule number 1, most things will prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1. Economics, markets, business, and the human body, the patterns never follow a straight line. And in our investment journey, it's a cardinal rule, be attentive to cycles. Our new fund offering, Mahindra Manulife Business Cycle Fund, aims to follow similar pattern. For more details, please refer Sid and Kim of the new scheme on our website www.mahindramanulife.com. Moment of the month. Markets continue to scale newer heights. Fed speak, 25 BPS hike, higher rate for longer. G20 forum continues to focus on renewable energy. Who moved markets? Strong buying from FPIs. Indian markets attract global investors with nearly $3.5 billion plus inflow for the month. It's a combination of India dedicated funds and allocation from emerging market funds. FPI liquidity drives markets and domestic flows moderate. FPI buying across market caps while domestic flows are directed to small caps and mid caps. Q1 results. Companies reporting in July put a decent show, with divergence across sectors. Consumption and IT moderates while financials, industrials and infrastructure report strong performance. Small cap continues to outperform, partly driven by hopes of supportive monetary policy and partly by strong investor flows in small cap funds. The sentiments towards small caps are quite positive, though valuations need to be watched. SML. Movers and shakers. Sector rotation. The fixed income glance. It was a difficult month for the domestic debt markets. Globally also the markets faltered. The benchmark 10-year India gilt rates increased by around 5 basis points, BPS, to close at 7.16%. The US 10-year also moved by around 10 BPS to close at 3.96%. Domestically, inflation moved up as the food inflation basket jumped up. While inflation in perishables, tomatoes, may be transitory, pickup in rice and pulses, combined weight at 7.25%, would require close monitoring. As they form a large part of our staple diet, a sustained price increase may lead to a generalization of inflation. On the global front, the US Fed announced an, as expected, 25 BPS hike. The Bank of Japan unexpectedly loosened its yield curve control. The ECB increased its rate by 25 BPS to 3.75%. Almost all central bankers sounded cautionary on inflation. What next? Globally, financial markets continued to look beyond the monetary policy actions of 7 large central banks, USA, Europe and Japan. Bond markets have put faith in rates higher for longer, while equity markets expect otherwise. Global sentiment and liquidity remain strongly in favor of equities. Rain gods have been kind in July. From a fear of drought, rains in July have taken rainfall to 5% above the long period average. Though the distribution is a bit uneven, excess rains in parts of northern India have disturbed economic activities and damaged infrastructure. We start the month of August with many more companies reporting for Q1 financial year 24. Broadly expecting a weaker set of numbers vis-a-vis those reported in July. Let's not forget Indian economy and markets continue to remain good, attractive highways ahead towards sustainable GDP growth and rising per capita income. For investors, what matters on this highway of fundamental growth is the occasional check on sentiments and valuations. A healthy combination of some discipline, courage and a bit of patience may keep investors on track toward a wealth creation journey. Financial markets have a history of creating business cycles for investors, where an economic cycle for any company or sector, growth in earnings coming from changes in revenue, costs, management, policy environment etc. is complemented with the market cycles that are prone to its valuation excesses on either side, created by sentiments, ownership, investors' leveraged positions as well as varied time frames. At times, the economic and market cycles may not run in tandem and may create opportunities to create wealth. Astute monitoring can help in spotting such opportunities. Summarizing our thoughts, we believe that the monetary policy of RBI may have an extended pause. Many global central bankers also seem to be in a pause, wait and watch mood. We believe that should there be an extended pause by the MPC, it raises the probability of a reversal in monetary policy action previously taken. History has a strange way of chiming, and it may be felt this time too. Our portfolio strategy across our duration-oriented funds runs in a similar vein. A. Relatively heavy on duration. B. Bias towards gilts. C. A steepening of the yield curve. Advanced economy central bankers have a Hobson's choice: not push the rates so hard that it pushes the economy into a severe hard landing and yet keep inflation in check. While China announced a policy push for economic revival, they don't seem to be large enough to push an inflationary pressure on commodity prices. Commodities, including agri-commodities and crude, have recently gone up. This may complicate the domestic inflation projection should rise and pulses prices push higher. A steady rate bias in interest rates may well continue through this calendar year. The bear flattening of the yield curve, especially in the 1 to 5 year segment, has largely happened, hinting at the possible end of the upward movement of the domestic rate trajectory. We also believe that AAA credit spreads have increased yet remain richly valued based on historical measures. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.